Now that we have figured out what the GDP is, and we've realized what the GDP actually measures, and what the GDP does not give us information about, what we can use it for, what it's not a good measure of, we can finally now turn our attention to actually figuring out how to measure it. And this is important because if we aren't clear in our heads about what's being measured and how those measurements operate, we will have some confusions about what's happening when we look at data. The first thing to remember is what we're doing with the GDP is that we are measuring what was actually produced. Not what I wish we had produced, not what I think we should have produced if you had given me an opportunity, not, oops, I shouldn't have produced that, now I can't sell it. If you produced it, I'm going to count it. So that's the key. What was actually produced? So the first thing to remember is the GDP is a simple measure of actual output. And that means that when I look at ways of measuring it, there's many ways I can figure out that I can use to measure the actual output. But it should not matter which approach I use, because no matter which angle from which I measure the GDP, the end number, the end result should be the same. It doesn't matter which way I measure something, but the total volume I get at the end of all that, in terms of the volume of the GDP, should be the same. And indeed, that is the case. So usually, we look at three very distinct approaches to measuring the GDP. They're useful because each approach gives me a different angle or insight into the economy. That's why instead of using only one approach, I like to use different approaches. It's also a way in which I can have checks and balances, because if I'm getting wildly different figures between these different approaches, it means something's wrong and I have to go back and check my numbers again and figure out what I did wrong in my accounts. So the first idea is that when stuff is produced, it generates income for people. I don't mean that you successfully sold it or not, and we're going to talk about what that is and why. I just mean that when a firm makes stuff, say you produced a car worth $1,000. I know cars are worth more than that, but this just makes my numbers easier, right? Then what I can do is I can say out of this $1,000, well, you know, this car's worth $1,000, right? Which means that, how did I come up with the worth of the car of $1,000? I figured, okay, maybe the labor was $600, right? So this I'm going to call wages. And then outside of wages, I'm going to look at my other factors of production. I'm using all kinds of factors of production to produce this car, right? There's interest. I must have borrowed capital from folks. I have to repay a portion of that to them. That's interest. Wages, interest. Maybe I have to pay rent on the facilities that I'm using to produce the car. So look at this, wages, interest and rent, 600, 700, 800, 850. How did I get 1,000? And the answer is I've forgotten. Profit. Essentially, if this is the value of the car, I take the cost and then whatever is left over by definition is profit. All right? So in this case, 600, 700, 800, 850, that means my profit was 150. And that accounts for the entirety of what's happening in the production of the car, right? It's possible that I made a loss instead of a profit, in which case it would be 600, this, and then this value is less and my profit's negative, right? But however I do it, can you see that if the car was worth 1,000, wages, interest, rent, and profit between them account for the value of the car. This is called the income approach, and it's useful if I am interested in questions of distribution. If I want to know how large is the wage bill in a country, right? So I can take a look at production. I can say, what is wages? How much goes into interest? How much goes into rent? How much goes into profits? And this gives me a sense of the sectoral distribution in terms of wages, interest, rent, and profit, or the factors of production. Who is getting how much of the stuff we produced, right? So that is the first thing that is useful, right? At this point, I'm just measuring. I'm not taking any position on whether this is good or bad. I'm also aware that different people fall at different levels in each of these. So there we are, right? So it's not always true that wage earners are poorer than, say, a small mom and pop joint which earns less profit. That's not what I mean. I'm just saying this helps me get a sense of the different ways in which income is earned in the country. So that is called the income approach. Another way in which I can do the GDP is, instead of looking at the incomes that are generated out of the GDP and seeing that they all add up to the total product, I can look at value added. This is called the value added approach. And what I'm doing in the value added approach is I'm saying, okay, let me look at different segments in a production and look at how much value was added to the GDP by that sector. All right. So if I'm looking at my $1,000 car, right, I'll say that so much of that value of 1,000 was made up of wages, interest, profit, whatever, that came from the steel manufacturer. And so that was $200 of steel that went in. And then this is the wages, interest, profit, and rent of the tech people inside the electronic systems that go into the car. And that is another 700, so it brought me from 7 and 9, and then another 100 is the goods and services provided by the people doing the retail and sales, and that'll give me my 1,000, right? So I can do it that way too. So the 1,000 that goes into the car, I can follow the value chain and look at value added. Now, usually when I look at value added, among things I'm particularly interested in is what level is value added by different sectors. The classic sectors, of course, are agriculture, manufacturing, services. And this helps me think about what kind of work are people doing in an economy. Is it an agrarian economy? Is it an economy where there's a ton of manufacturing going on? Is it highly dependent on services? So this is a different look or view into production. I'm still going to get the same GDP, but I'm getting at it from a different angle. And this breakdown in this way gives me a value added picture of an overview of different production sectors in an economy. Right? And then the final way to measure GDP is called the expenditure approach. So we had the income approach, we have the value added approach, and now we're going to look at the expenditure approach. Now the expenditure approach is a little bit tricky. It's the one most famously associated with Keynes for various reasons, as we'll see as we go on. But it's also a little tricky because just as in the income approach, your first thought was, wait, how did it all add up? And I had to remind you, wait, profit is a residual category. That's why it automatically adds up. In the same way, you're going to find that one of the categories here is a kind of slightly deceptive category. And it doesn't make sense unless you realize that. And the expenditure approach basically takes the idea that if I produce something, it ended up somewhere. So I'm going to look at all the places it could have ended up. So here it is. This is the GDP. I produced it in this country. It could have been bought by somebody. It could have been consumed. Consumers. I'm going to talk about this additional one. It could have gone to firms, right? Because sometimes I produce a computer, I don't necessarily sell it to a household, I might sell it to a firm that's going to use it for its expansion or whatever. This I call investment. So here's the first thing that we're going to think about, is that there's something going on in this category that I'm going to come back to. But investment in economics never means stocks and bonds. It does not mean finance. Stocks and bonds and finance is borrowing and lending between people, but it is not actually an indication automatically of production that is going to firms to help engage in future production, right? So investment in economics very specifically means only actual new final goods and services that entered the firm sector. It does not mean any of these other things you might have learned or thought about in terms of I have an investment stock portfolio or whatever. None of that, right? Only this is a macro. We have to remember that there's more groups of people than just consumers and investors. Government buys stuff. Think of Boeing in this part of the country. Boeing has been a very important producer. They produce airlines. Some of these are produced by, these airplanes are bought by airlines, but many of them are bought by the military, right? So it could go to the government. Now, again, we have to remember in economics, in this approach, we're going to have to change this and think this through when we come to government budgets. But here in the expenditure approach, G is only purchases or acquisitions of new final goods and services by the government. So if the government gives you a welfare check, that's not G, right? Because that is not a new final good or services, right? Only if the government acquires new final goods and services, defense spending, judges, that kind of stuff. That's what comes in here, right? So I produced this computer or this car. Some of it was bought by households. Some of it was bought by industry or stayed with industry, and we'll talk about what that difference is in a minute. Some of it went to the government. Some of it we sold to foreigners. And I'm going to use the word X for exports. This is just a convention, right? And that's because, as you'll see, we are going to use that letter E for something else, and so we're running out of letters, so we use X for exports. But then we have to remember, wait, GDP is measuring what was produced in my country, right? So if I look at what consumers bought, some of those cars they bought might have come from abroad. They might not have been produced here. So I'm going to have to get rid of the stuff that they bought from abroad, minus M, imports, right? C plus I plus G plus X minus M. We're going to keep coming back to this equation. Here is the key. In the expenditure approach to measuring the GDP, I'm not assuming that each one of these groups managed to attain what they wanted. In particular, here's a pen. It was produced this year. It's a new final good or service. I produced 20 pens. I thought that it's going to be really great. School's going to start. I'm going to sell it. All right. Next thing I know, COVID hit. Students are not there. Here I am. I'm sitting here with all these pens. Produced it. New final good or service. Didn't go to consumer. They didn't buy it. Government's not interested in it because schools are shut, so educational institutions are not buying stuff. You know, it's not exactly something that's going to be competitive for me to export, right? So where did this pen go? I produced it. It's part of this year's new final good and service. I'm a firm. I produced pens. I wasn't able to sell it. I wasn't able to give it to the government, sell it to the government. I wasn't able to export it. Where did it go? Answer, it didn't go anywhere. It just stayed on my shelves. It stayed on my shelves, which means that in addition to capital goods purchases, right? Stuff that stays with the firm in inventory is also so the capital goods would be things like, you know, part of what the firms are buying are machines, tools, industrial production. But what's also happening inside this I is some of the stuff is firms' inventory. And inventory is a very interesting question because inventory can either mean the firms actively maintain inventory because no firm wants to be in a situation where somebody came to buy something and there's nothing on the shelves. So it's useful for firms to maintain some inventory. But at the same time, inventory can also just mean you produced it and you weren't able to sell it. It just accumulated on your shelves. So even though I looks lovely, more investment looks lovely, you gotta interrogate that number. That number could look big, and it could look big because yes, the firms are buying tons of machines, they're building new sort of equipment, they're expanding production. And that could be a nice big number. Or that number could look big because stuff is accumulating on the shelves. I've got a lot of investment because I wasn't able to sell it to anyone. It's sitting in my inventory. That number is way too big because I'm actually not able to move my stuff. So a big number means nothing until I have some drilling down to look at how much of it is actually new capital formation and how much of this is inventory, and under inventory, how much of this is planned. That is, I actively decided I want to keep some pens in my inventory so that when students walk in, I'm stocked. Or it could be unplanned. I didn't intend to end up with this pen. I just ended up with it because I wasn't able to sell it. It ended up in my stock, and there I am. All right. So we're going to spend a lot of time understanding that part of what's happening in all these measures is all I'm doing is I'm measuring production. So far, I have no theory about why people produce what they produce, how it gets distributed across the economy, and so on. All right, I have to go there. But the expenditure approach, then once you understood that I includes unplanned inventory, then you understand that just as income approach is like interest, wages, rent, profits, and they all add up to my total product. Value added approach, agriculture, manufacturing, services, and they all add up to my total product. In the same way, expenditure approach, C plus I plus G plus X minus M. Consumers, firms, government, rest of the world. Stuff ended up there. And I have to think through very carefully who ended up getting the stuff. Were they planning it? Were they stuck with it? What was going on? And this expenditure approach, which is the one that Keynes really focused on, is going to help us understand some of the most important contributions of macroeconomics having to do with levels of production, recessions, booms, busts, and so on.